Welcome to the deep dive. We're taking that daily flood of information, all the noise, and we're boiling it down. Boiling it down to what actually moves capital, what actually defines the balance sheet of a state.
And today, we're doing a really focused analysis. We've got a stack of sources here, all from the Israeli publication Haaretz, dated December 22, 2025.
And the mission is pure clarity.
Exactly. We're trying to cut through the political commentary, the ideology, and just find the structural events.
The things that materially impact finance, economics, and, the long-term costs of just running the country.
We want to understand the machinery.
Yeah, where's the financial leverage? Where's the competitive advantage maybe
That's right.
eroding? And what choices are being made right now that lock in huge costs for decades?
It's all about comprehension. This is a calm look beneath the headlines to see the integrated economic logic.
Okay, let's get into it. Where should we start?
Let's start with the most obvious external anchor, the money.
Right. One of the biggest pillars for any state's stability is, well, its relationship with its biggest allies.
Especially when that relationship involves massive flows of defense capital.
And the source material here is highlighting this growing pressure to end U.S. defense aid, which really puts the spotlight on what that security blanket actually costs.
And what's fascinating isn't just the number, the total sum, it's the structure of the aid.
The structure?
Yeah, because that structure dictates this really complex web of corporate winners and losers. The current agreement, the MOU.
The Memorandum of Understanding.
Right. It provides a steady $3.8 billion a year.
And that's the key, isn't it? It has a hard expiration date in 2028.
It does, which puts a ticking clock on the whole defense budget.
You're looking at a huge fiscal cliff, potentially.
A massive one. But let's zoom in on the mechanism, because that's where you see who really benefits. The vast majority of that money, it's about $3.3 billion, is what's called foreign military financing, or FMF. And that FMF money is heavily restricted.
So it's not just a blank check. It's not cash the government can use to, shop around for the best gear globally.
Oh, not at all. Far from it. That money must be spent buying U.S.-made military equipment and services.
Okay, so if you connect the dots, this is basically a direct annual subsidy for the American defense industry.
It's a guaranteed revenue stream. We're talking about the huge players, Northrop Grumman, Lockheed Martin, Boeing.
So it's a self-perpetuating system.
In a sense, yes. The aid secures Israel's defense, which in turn secures profits for American corporations.
Who then have a vested interest and a lot of influence in Washington to keep that aid flowing.
Precisely. And the sources get specific about the hardware. We're talking F-35 fighter jets.
Which are, what, almost $100 million a pop?
About $98 million each, yeah. And AH-64 Apache helicopters, around $35 million. Advanced missile systems like the AMRAAMs.
This is all top-tier, capital-intensive stuff that's being bought at a discount, thanks to this subsidy.
Exact.
But let's play this out. Let's look at the other side. What if that MOU isn't renewed or it's cut way back?
Well, the state doesn't just lose $3.8 billion.
No.
It suddenly has to find the cash to buy those $98 million jets and $35 million helicopters at full price from its own budget.
That's the real financial exposure that's being shielded right now.
It is. If that subsidy vanishes, you're left with two very, very expensive choices. Either you dramatically hike the domestic defense budget,
pulling money from education, healthcare, everything else,
or you have to fundamentally change your entire military doctrine, your entire capability. It's that serious.
So that's the external capital. A whole system is propped up by it.
It is.
Which I think leads us perfectly to the internal capital, or maybe the lack of it.
The human capital.
Exactly. We've laid out this external liability. But to understand the country's ability to actually meet those costs on its own, you have to look inside.
And this is where the source material points to a vulnerability that's much quieter than a missile system, but maybe even more damaging in the long run.
The brain drain, the flight of highly educated talent.
And the numbers here are, frankly, deeply worrying for the country's long-term economic future.
Okay, hit me with it.
The key statistic that just jumps off the page is this. 25% of Israelis with doctorates in mathematics and science are currently living overseas.
Wait. Say that again. 1/4.
1/4.
A full 25% of their absolute top-tier scientific and mathematical minds. The people who literally drive the innovation in the startup nation, they're not there anymore.
They're based elsewhere. And it's not just in those fields. If you look across the board, the number is 18% of all Israelis with doctorates living abroad.
18%. How does that How does that compare to other developed countries?
That's the thing. It's exceptionally high. Most comparable OECD countries, our Western peers, they average maybe 4 to 5%.
So it's almost 5 times higher. The scale that's undeniable.
It's a huge difference.
But are we sure this is permanent? I mean, couldn't some of these people be working remotely for Israeli companies?
The sources focus on those living overseas, which is the key metric. It means their salaries, their consumption, and crucially, their R&D capacity is primarily benefiting foreign economies.
Foreign universities, foreign corporations.
Exactly. The material suggests this is a structural shift.
Yeah.
People are leaving for higher salaries, better research opportunities, and, maybe a desire for less regional instability.
And you said the 25% number is up?
It's nearly double what it was just a decade ago, between 2011 and 2014. So this isn't static. It's accelerating.
An accelerating export of talent.
And it's happening in the most critical sectors, the very engine of the economy: computer science, math, engineering.
So when you lose that critical mass of researchers, you're basically just exporting your future, your R&D, your innovation capacity.
It translates directly into less corporate growth down the line, less intellectual property being created, potentially a smaller tax base. It's like an internal bleeding of wealth.
Wow. Okay, so a clear picture is starting to emerge here. The state is, on one hand, heavily dependent on billions of dollars in subsidized foreign military gear to stay secure. But on the other hand, it's simultaneously exporting its most valuable commodity, its intellectual firepower, to the very countries and corporations that are part of that same global system.
The irony is pretty stark, isn't it? The very capacity to innovate your way out of a problem or to pay for your own security is being weakened by this human capital flight.
And it's happening right as the external financial support is facing an expiration date.
The timing couldn't be worse.
And that takes us right to the next piece. How domestic policy decisions are actively making this whole situation more expensive and a lot more risky.
Exactly. So let's pivot to state actions that directly impact land and sovereignty.
Decisions that, regardless of your politics, have an immediate and massive price tag, the kind of thing capital markets pay very close attention to.
And we're looking at two big ones in the sources. First, there's the government's decision to legalize 19 previously unauthorized settler outposts.
Okay, this is a huge event. What's the legal context here?
Well, in simple terms, the move reverses key parts of the 2005 disengagement plan, which was actual law. So this is a formal legislative action.
But you're focused on the financial side. How does legalizing an outpost immediately show up on a balance sheet?
Because the moment they're legalized, they become an official part of the state.
And the state has to provide services.
The state is now mandated to spend enormous amounts of money. You're talking infrastructure, roads, water, power, and then the long-term costs for security, for defense, for integrating them into the legal system.
So you're locking in a budget commitment that will stretch out for decades.
Decades. And you're doing it in contested territory, which guarantees a significant and permanent drag on future budgets.
And this doesn't exist in a bubble. This has to feed back into that first conversation we had about U.S. aid.
It absolutely does. This kind of policy directly creates geopolitical friction, especially with the U.S. administration.
And that friction has a potential cost.
A very specific one. You risk influencing Washington's decision-making when that $3.8 billion aid package comes up for renewal in 2028.
So you're actively driving up your own security costs while at the same time potentially weakening the subsidy that helps you pay for them.
It's a difficult equation.
And separately, the source material points to other actions that are also running up a huge future bill.
Yes, the continued raising of buildings and infrastructure in Gaza by the IDF, even months after the main conflict phase was supposed to be over.
And this is confirmed.
Satellite imagery confirms it. The sources detail large numbers of buildings being destroyed in specific areas well after the initial combat ended.
And from a purely economic standpoint, that destruction is just a compounding loss of capital assets.
Exponentially. And the financial reality is that at some point, that loss turns into a bill that someone has to pay.
A reconstruction bill.
A massive one. A bill that will depend entirely on regional stability and international aid. So this active destruction just perpetuates a state of deep economic instability.
Which, again, raises the risk premium for anyone looking to invest in the region and forces the state's own security budget to remain high indefinitely.
So whether you're talking about legalizing outposts or raising buildings.
Right.
These are both large-scale state actions that are dictating massive future spending and ratcheting up the overall cost of governance and conflict.
And that brings us to the integrated picture we were looking for. We went through the sources from late 2025, looked past the day-to-day political noise, and we found, I think, 3 converging structural risks.
They really define the state's future economic viability.
So first, you have the external financial dependence.
Right, the reliance on that $3.8 billion U.S. aid package, which is racing toward that 2028 fiscal cliff.
Then second, there's the internal talent erosion.
The brain drain. That staggering 25% of math and science doctorates now overseas, which is just systematically hollowing out the high-tech R&D sector that the economy is built on.
And third, what you just laid out, the policy-driven instability.
Yeah, these major decisions on land, on military operations, legalizing 19 outposts, the ongoing destruction, they all create geopolitical risk and lock the state into huge mandatory future spending.
So these 3 things, the foreign reliance, the internal brain drain, and these expensive policy choices, they're all converging.
They are. They're creating a really severe cost-capacity crunch. The state's ability to sustain itself, both financially and intellectually, is being challenged from the outside and from within.
It's a confluence of structural liabilities that really defines the country's financial posture right now.
I think that's the clearest way to put it.
We want to leave you with one final thought to mull over. Think about the word sovereignty. Is a state truly sovereign if its security depends so heavily on foreign financing, and if its main source of innovation and wealth depends on a pool of talent that is systematically choosing to live and work and contribute somewhere else?
It's a profound question.
What's the true cost of geopolitical stability when you measure it not just in dollars, but in your most valuable and dwindling resource?
Yeah.
Human capital. That really frames the whole conversation going forward.
Thank you for joining us for this deep dive. We'll see you next time as we continue to decode the world's complex balance sheets.